Good morning, everybody. We are live here at Benzinga. Today is Wednesday, November 6th, 2025. I'm Gianni DiPoce, your host, and I am joined with Direxion, our friends over at Direxion. We're going to be discussing volatility, momentum, and the endgame, leveraged ETF strategies for the fourth quarter and beyond. And I'm joined by Eliott Wellenbach from Direxion. Eliott, how you doing today?
Gianni, great to be on with you again today. I'm excited to discuss some trading ideas. How you doing?
I'm doing good. I'm up here in the Midwest, and it's starting to get a little chilly. It's been a nice fall, but we got some cold weather coming in. It looks like it's a sunny day where you are in NYC too, so that's good.
Yep. We're a little bit behind you, but we're getting the cold weather soon.
Yes. Well, I think the timing of this conversation is excellent. We're a few days off of the all-time highs here. We've seen some spikes in volatility and the VIX over the last few weeks. So fortunately, there's a lot of things that we can do in this environment. Capitalize on some short-term trading swings in this market. Looking at some hedging against the trend, perhaps. So I'm really excited to have this discussion with you.
No, likewise. No, and I think maybe let's kick it off with just a brief overview of some of the trading strategies. And just no financial presentation would be complete without a great disclosure slide. But in all seriousness, before trading any leverage ETFs, please take a look at the website, the prospectus, make sure understanding how these products work and what you are trading. But on the next slide, just kind of a brief background of who Direxion is. We were founded in 1997, and we really have become a leader in the tactical and leverage and inverse space. Specifically, we have over 118 ETFs ranging from single inverse all the way up to your triple leveraged and inverse ETFs. We have, depending upon the day, we have right now about 60 billion in assets under management. And again, we're really a leader in derivative-based products, and that's what we specialize in, and different trading solutions. But enough about us. Just on the next slide, we're going to talk about just a brief kind of overview of the leverage and inverse industry. So right now, it's grown to about 112 billion in assets under management in the U.S. across various market segments and products. And wanted to show everybody joining in today just the breakdown of products by assets. So you can see heavily skewed towards the triple leverage space, and that is triple leverage long bull products. There's a lot of bulls out there. You can see kind of the breakdown that it's triple, then double leverage long, and then you get to your inverse products. So a lot of bulls out there, but never forget that there are always strategies for bear markets and to trade downward price swings. And just on the next slide, I'm talking about these leverage and inverse ETFs. What does that actually mean? So these funds have daily investment objectives depending upon their leverage exposure. So that can be 200 or 300% long for our bull funds. And for our bear funds, that can be 200, 300% inverse. And what does that mean with leverage is that for every dollar invested, you're getting $2 or $3 worth of exposure. But just to go back to that daily, we all use the term daily a lot because these are vehicles designed for short-term tactical trading. These are not designed as buy and hold investments for a few reasons. One of them being that you have leverage exposure. So you have magnified higher risk, but also these funds rebalance daily. And what do I mean by that is that we make sure that you start off every trading day with that targeted, whether it's 200 or 300% leverage long or inverse exposure, and that can have the bring up the issues of compounding. Compounding is not a bad thing necessarily, but it can be it can hurt the return of these vehicles on periods longer than a single trading day. And just on the next slide, just to kind of provide a high level of this can seem like a little confusing and a lot, but it's meant to explain why these are short-term vehicles and why these are tactical trading tools. So just to quickly walk through this, on day one, you have you're in a leverage long fund, 3x. You have $100 invested. What does that mean? You're in a triple leverage product. You have $300 of initial exposure. In that day one scenario, the the ETF, the underlying benchmark, moves up 5% because you're in a triple leverage product. That ETF moves up 15%. At the end of the day, your $100 is now $115. But what we're going to do is you would only have $315 of exposure. We're going to make sure that you start off the next trading day with $345 of exposure. So we're going to go out and buy additional exposure. Why does that matter? It depends upon the following day, whether it's a bull or a bear, kind of day. And I'm gonna, on the next slide, it will be come together a little bit easier. I'm a visual learner. So one thing I did not mention is trend is your friend with these products, and by trend I mean trend of the underlying index. So in this scenario, we see a multiple day period where the underlying benchmark in orange is trending up. So in this scenario, you have an overall trend up, and your bull product is actually outperforming a 3x return of that benchmark in that period, and the bear product is down less than it should be. And again, that's because of that daily rebalance, because we're rebalancing the funds at the end of every trading day. So again, trend is really your friend. And this is a great scenario. This is best case scenario, but the scenarios that do happen, and what we want to make sure that anybody trading this is aware of is on the next slide. So on the next slide, this is a non-directional, more of a whipsaw market environment. As you can see, the underlying benchmark, again in orange, is relative. It's up a little bit. There's been a couple days of volatility, moves up and down, and in this scenario, this is where the triple leverage bull fund is not up 3x of the underlying benchmark. It's up less than that. And the bear fund is actually down more than a 3x return. So what I'm trying to illustrate in these scenarios is that these are short-term tactical trading products. The trend is your friend. These are really intended as short-term tools for traders that understand these products, understand the risks associated with them. And it's really important before making any trade, especially in these products, to understand how they work. And we'll get into a little bit more of that, but just on the next slide, we're going to just talk about a little bit of how can these funds be used. So you can use them for opportunistic trading, short-term directional moves, with leverage exposure. You can use them as hedging tools. Our inverse products is a great way to get a packaged hedging solution in an ETF format, instead of there are a variety of different ways to hedge. Through options, margin, whatever it may be. But with these products, you do not need to have a margin account. You can hedge with these products, whether it's using a single inverse or more of a tactical trade of inverse 2x or 3x. And then another way of these products are used is the idea of portable alpha, and by portable alpha, simply I mean gaining amplified exposure with less capital down. The idea of using leverage, again that triple leveraged example. For every $1 dollar down, you're getting $3 of exposure. And a lot of our traders, and what we're going to talk about later with Gianni, is that a lot of technical indicators can be used for trading these ETFs, and great ways to trade them. So um, and just on the next slide, I'm just going to talk about a little bit of our lineup quickly. We're known for our leverage and inverse ETFs. More recently, on our next slide, you'll see our leveraged single stock ETFs. So single stock ETFs, we started launching these about 3 years ago. We've seen tremendous growth in this area. We have about 23 pairs now, and by pairs I mean you'll see on this page that for example, Apple. We have for every single stock ETF, we have a 2x bull. So that offers 2x daily exposure, and then we also have another ETF that's a single inverse bear, a way to hedge, or take an inverse view on a single stock. So these have grown. These have become very popular, especially around earnings. In the past 3 years, they've grown to about 20% of our assets, and in 2025 this year, across all the ETFs launched, approximately 20% of all new ETFs launched this year have been in the single stock space. And just on the next slide, you'll see that we just have, that's our continued lineup. We have all of the Mag 7 names, your mega cap tech, quite a few of the semiconductors, and then quite a variety of different single stock ETFs. And then on your next slide, we're just going to review actually something that's really exciting and new is our Titans leverage and inverse ETFs. On the next slide, this is expanding our suite. This is a great illustration of, the different ETF, options that we have. So we have our broad sector, our broader market ETFs that are leveraged. We have our Titans, and then even more concentrated, which I just spoke about, is our single stock. The Titans are a concentrated basket. They provide exposure to the top specific sector based on their market cap. So this is equally weighted across those 5 names. So you don't have quite as much individual security risk and concentration. So we have those top 5 names equally weighted. It's a way to, again, you have the broader sectors to trade, all of your, sectors, subsectors, and then you have your Titans that you're able to trade that concentrated basket that's really those top 5 names, and then you have your single stocks. And just on the next slide, this is our current Titan lineup. We have the technology select sector, semiconductors, biotech, and energy. And you'll see that for technology and semis, we have 2x bulls, as well as 200% inverse bears, so 200% inverse, again, on those top 5 names. And it's a great way to trade, those concentrated baskets. And now for the fun stuff, I'm going to hand it over to Gianni so we can talk about some trading ideas, and what he's seeing right now.
Yeah, I'm glad that you have these new funds. I did have a question. Do you not have the 2x inverse yet for biotech and energy?
We do not at the moment. Right now, we just have the total of the 6 out, and only inverse on the semiconductors and technology. So only bulls for the Titans, at least in biotech and energy.
Okay, well, it's actually interesting because I'm leading off my my presentation today with the biotech sector, because it's been something that I have been watching very closely lately. So we can get and pull up my slides and start going through some of the material that I have, because a lot of opportunities in this market right now. There's a big shift taking place. It's pretty remarkable when you look at it, because you had the volatility to start the year. You had the tariff tantrums, as I like to call it. We bottomed it in April, and it's pretty much been straight up since. Now we're a few days off of the all-time highs now, but really since April, we have seen the tech sector and semiconductors especially lead this rally. This has opened up a lot of opportunities to take some, levered concentrated bets on the long side. But, even today, you're seeing quite a bit of volatility and some short-term selling creep into the semiconductor space. A lot of it has to do with AI, right? So when we think of the whole AI trade, you think of names like NVIDIA, things of names like Advanced Micro Devices. It seems like every other week there's a new announcement with OpenAI saying, "Hey, we're partnering with such and such company," and the stock gaps up 10%. But what I want to talk about, I think, is the next phase of AI. We've heard nothing but semiconductors, data centers, and how big tech is going to leverage this and boost their profits, and et cetera, et cetera, et cetera. But I don't think we've heard enough about the story when it comes to artificial intelligence and the biotech sector. I mean, you think about not just biotech, but it falls under the healthcare umbrella. And let's not forget, we always hear about tech, right? It's all about tech. This market lives and dies by tech. But healthcare is the second largest sector in the S&P 500 behind technology. And so whether it's, going through data and drug trials, or, helping healthcare companies administer healthcare better, saving costs like that, I don't think we've been talking enough about how AI can benefit the biotech sector and healthcare in general. So I'm actually looking for this to become a big theme going into 2026. You can see I have this chart here. It's the S&P Biotech Select Industry Index. So Eliott mentioned something very important, is that when you look at these short-term funds, bullish or bearish, they're all tied to some sort of index that's out there. And this is the index that the biotech levered ETFs track. And I have a long-term chart up on this. And so you're not going to necessarily use a chart of this length to make a trade in the short term. But regardless if you're a day trader or a swing trader or whatever type of trader you may be, you always need to be aware of what the trends are across different time frames, because you can have a market that's in a long-term uptrend, intermediate-term uptrend, but a short-term downtrend. And so that's the beauty of these levered ETFs, is that it gives you enough firepower, so to speak, to actually capitalize on those short-term counter trend moves if that's what you want to do. But I'm going to talk about today some of the best practices that I use as a trader when it comes to trading with the trend. Eliott mentioned the trend is your friend. It's true, but all trends eventually do come to an end. But the catch is that a lot of trends tend to last longer than many expect. And it's been said that the market can stay irrational longer than you can stay solvent. And so you're seeing all these traders come out in the last few weeks making these huge bets against AI. They're trying to time the absolute top. Well, I don't think that's actually the best way to make money in this business. And of course, you're going to find out what works for you. But let's shift gears a little bit and talk about what actually constitutes a trend. So, okay, we're looking at a weekly chart here of that S&P Biotechnology Select Industry Index going back to actually late 2021. And this is pretty profound, because you look at what stocks have done over the last few years. There's not many sectors out there that have not hit a new all-time high. In fact, it's been all-time highs across the board for many sectors, many individual stocks, many sectors. Okay, there's talk lately, there's not enough market breadth, but that's beside the point. You're still seeing leadership from strong areas of the market. But let's just talk about how the trend has evolved in this sector specifically over the last few years. So, you had the bear market of 2022, right? But it actually started trending lower earlier in 2021. You have these lower lows and lower highs. Each following low is below the previous low, and each high that follows is beneath the previous high. So you form this absolute bottom in 2022. You had a higher low here in late 2023, but you really weren't seeing a lot of great opportunities, clean trends. And a lot of traders do get chopped up in the chop, so to speak. So, you had this higher low, you took out this high from 2022 and 2024. Okay, is this trend starting to climb and become bullish again? You made a higher high in late 2024, but then you had a really sharp sell-off earlier this year that took out that low of 2024. So that caused some serious problems when it comes to the integrity of the trend. I'm going to show you plenty of examples of stocks and sectors and markets in clean trends, and you're going to see some examples of really messy trends, and that's actually a tough environment to trade. But since this low in April, we've seen biotech be very strong. You've taken out the high, not just of 2024, but of 2023, obviously, and you're kind of in the ballpark of testing that high of 2022, which formed in that first week of that year. So this is a sector that I'm looking for a massive rotation into, and I think there's going to be some bullish opportunities here. So we just talked about trends. You have the triple leveraged bull biotech ETF from Direxion, LABU, as I like to call it, LABU. And you can see here that since April, the trend has very clearly been higher. Now, what I want to do next is kind of build off this knowledge of how trends can work in your favor. So the way I trade is that I try to trade in the direction of the underlying trend as much as possible. So again, there's trends across different time frames, long-term trends, intermediate-term trends, short-term trends. These are short-term trading vehicles. And so while you need to have in the back of your mind what the weekly trend and the monthly trend may be, when it comes to actually pulling the trigger and making decisions, you need to be focused on daily charts and even intraday charts. I don't have any intraday charts here with you today, but the daily chart is going to be your best friend in terms of, looking in terms of timing, entries, exits, etc. So, okay, we have a trend here, but obviously trading is more than just trading with a trend, right? You look into time, entries, capitalize on risk versus reward. I'll talk more about that towards the end today, but you can see here that there are periods and kind of like zones of congestion in the chart. And a lot of times these can be characterized by what's called support and resistance. And so in this case, you have a couple of areas where prices stalled. You had one right here back in September, and you can see how this was the same price zone of where we were back in March. This is what's called a resistance zone. Why is it resistance? Because prices were rejected at this level. Okay. The rally stopped going up for a period of time. Eventually it overcame it, but how I want you to think about resistance and support are in terms of supply and demand. Okay. Resistance is simply an area where there is more supply than demand. When there's more supply than demand, prices will stop going up for a time and even come back down. But we all know that supply and demand are not static. They change. They're dynamic. People's perceptions on markets and what's valuable and what's not is always changing. So even though there was a resistance zone here, clearly there was more demand for supply in time. And then when this resistance broke, it became support. So again, these support and resistance zones are not static either, just like supply and demand. So you had demand overtake supply. Prices continued higher. That's really what happens when prices are rallying, right? There's more people that want to buy shares of something than they want to sell it. And then you had a little bit of congestion here. You eventually overcame that. But look how we've come back down, and you're testing that level right now. This chart. All these charts are as of this morning. Don't have today's intraday action on it. But you're holding on this former resistance turn support. Okay, so if you miss this swing up in biotech, if you want to buy support and sell resistance, that is a way to trade. It's not the only way to trade. I'm going to show you a couple different strategies here. But this is a very simple, basic way to start looking at these. What is the trend? Are we pressing up against support or resistance? Can I take a swing here? Because then you think, okay, well, if I'm going to be buying here in support and then support breaks, well, then I have an exit plan. Right? When you get into a trade, you need to have an uncle line, if you will. Like, okay, I bought this ETF. It's not working for me. When do I admit that I'm wrong? Because you can't hold on to these funds and just, pray that they're going to come back. Hope is not a strategy in this business. So let's look at the other side of this market. You'll see LABD, LABD. Okay. No surprise that this has been trending lower. You can see how these were support zones that you eventually broke. They became resistance. You broke beneath that, came back up, and then rallied back above there. and then you eventually got slammed back down lower. Then you congested a little bit, dropped into the support zone, congested some, and then eventually dropped even more. So pretty bearish setup that I'm seeing on the bearish side of biotech. And when you look at the index here, the Biotech Select Industry Index, it looks like the trend is up. So I'm going to be favoring Labu over LabD going forward here for the next several months until we see a meaningful flip in the trend. Okay, I have another part of this market that is really garnering my attention, and it has to do with small caps. So we are using the Russell 2000 index, which tracks 2,000 small cap stocks in the United States. And, there's all this talk of stocks being in a bubble. Okay, well, yeah, there are definitely individual stocks that are in a bubble. That happens all the time, almost in any market environment that you're operating in. I guess except bear markets, but then you can, flip that on its head. There's going to be stocks that are, oversold too much too. So you look at the Russell 2000 here. You had an all-time high at the time in late 2021. You briefly took that out in 2024, but then you had that sharp sell-off earlier this year, and you can see now that we're just barely higher from where we were all the way back in 2021. Okay, and even last year, but you did see some nice higher highs and higher lows coming out of this low back in April. But the big story here is that U.S. small caps are not in a bubble. And so if you're looking for value in an area of the market that is discounted relative to what has been running to the upside so much this year, I think you need to have a look at small cap stocks. Now, we have a pretty interesting backdrop, from a macroeconomic standpoint when it comes to small caps right now. Because a lot of these companies, I think it's something like around 20% of small cap stocks are not profitable right now. And so that means that they're living on debt. They are living on borrowed time. The Fed has started to cut interest rates again. Powell hinted last week that they might be pausing in December. I don't think he will. I think they are going to cut. But the reason I say that is because when you have companies that are not profitable living on debt, these rate cuts are kind of like a lifeboat for these to try to keep them alive a little bit longer, if you will. So you have this trend that is turning higher here in the small cap Russell 2000, and you're making higher highs and higher lows. You also have what I like to call a saucer formation. This is a beautiful pattern. And you've built this tremendous base. So we're going to start talking about some price patterns on these charts. We've already covered trends. We covered support and resistance. But patterns, I think, are even more powerful because it gives you kind of like a deeper look into the psychology of the investing public that a lot of people don't understand. So as a trader, you're going to need to find an edge that helps to give you signals that kind of look past the news, look past the headlines, because you need to be making decisions on your own versus relying on anyone else to help you make them. And so this pattern has been forming over the course of the last 4 years. This is a big pattern. It falls into the category of the bigger the base, the higher the space. As a rule, markets that come out of patterns that have been forming for a longer period of time will exhibit bigger price moves. So, we looked at biotech coming out of a, long-term bear market, and I'm looking at now small cap. I think there's gonna be a lot of opportunity in small caps going into year end, going into 2026. And it just so happens, guys, that there's a lot of biotech stocks in the Russell 2000 in the small cap sector as well. So, you can see how we're kind of building out a theme here. Lower interest rates, rotation into lower areas, lower valued areas of the markets. And this is building a pretty bullish case. And then there's the whole AI thing as well, right? Where that can help the biotech sector. So let's go ahead and take a look at the triple leveraged 3X bull small cap ETF. TNA is the ticker symbol. We have been trending higher for most of this year. Unsurprisingly, we are now rising within what's called an ascending channel. We are channeling. Some people will say, oh, this is an algorithmic channel. Okay, fine. I do think that a lot of the algorithms are operating kind of with some of the mathematical principles that go into the formation of these patterns. And you have to understand that something like 90% of the volume in today's market are driven by algorithms. So it's pretty important to understand how those work. It's all math, guys. It's all math. You don't need to be a math expert to understand it either. So, you've been trending higher, and basically the way these channels work is that as long as you stay within the channel, it's bullish. If you get a situation where you start to break above the channel, it can start to go parabolic. You break below the channel, it doesn't necessarily mean the trend to the upside is over. It just means that the slope of the rally, or the rate of ascent, the speed at which the market has been rallying, is no longer in effect. And then you go into a period of digestion, consolidation, choppiness, so the market can kind of regain its bearings and figure out what it wants to do next. So you can see that we've been channeling to the downside in the 3X bear small cap ETF, TZA. But why this is important is because if we are going to see volatility accelerate here, maybe over the next couple of weeks, there could be a swing long opportunity on TZA. And what you would be looking for is for prices to break above this downward sloping upper trend line of this channel, and maybe look for a few percent drop on the index itself, 3x that on TZA, and then you have your target. So right now you'd be swimming against the tide, trading TZA. I think you'll get more bang for your buck in time in TNA. But again, these are designed for short-term tactical moves. It's up to you to decide, hey, do I wait for a pullback and then take a swing on TNA? Or do I just think we're going to drop right now and I want to capture a few percent on TZA because of the downside exposure that you get with the Russell 2000? Okay, so let's shift gears. We were talking about stocks. One sector that I like, that was biotech, kind of like a broader asset class or segment, sector of the market in the Russell 2000. Let's talk about a completely different asset class right now in treasuries. Okay, so this is really important because there's a lot that goes into the treasury market. We're looking at long-term treasuries specifically. Okay, so you have TMF and TMV. TMF is the 3X 20 plus year treasury ETF, and basically you're looking at long-term bonds. Long-term bonds are important because, this is the area of the bond market that is most sensitive to changes in inflation expectations. And over the last couple of weeks, there's not been a lot of economic data released because the government's been shut down. Well, it looks like that's coming to an end, hopefully coming to an end here soon in the next, week or so, because then that way we can start getting more data. There's not been employment data. There's not been inflation data. We're supposed to get some inflation data last week, but bonds have kind of been operating in no man's land. Now, what's really interesting is the last 2 months, we saw the Fed cut rates. And in both instances, it was a buy the rumor, sell the news event. You saw bonds rally into the rate cuts and then sell off. But don't get it twisted, guys. When the Fed cuts rates, they're not cutting rates in long-term bonds. I need you to understand that very carefully. When the Fed cuts rates, it's only in short-term bonds. We're talking interest rates that have, an effect on really just treasury bills that have a maturity of 1 year or less. And so you have interest rates for different periods of time, right? So you have interest rates for 1 year or less, interest rates for 2 years, 5 years, 10 years, 20 years, 30 years. We're looking at long-term rates specifically with these funds. Okay, now why does it matter? Because it's kind of like the tail wags the dog in this case, because the Fed's not messing with this area of the bond market. They were during QE, but we're not in QE anymore. We haven't been in QE for, what is it, like 3 or 4 years now? Time really has flown by. So the Fed's not touching long-term bonds. And so this is actually trading according to, more market forces now than short-term T-bills, which is where the Fed raises and lowers interest rates. And so we've been selling off hard. You're actually up a little bit today, but you're coming off this higher high. And so that's noteworthy because, since this low back in May, you've been making higher highs and higher lows. But what I would be looking for is to make sure we don't take out this low from late September to the downside. If you take that out, it signals from the bond market that, hey, something is wrong. Is inflation making a comeback? Is the Fed losing the plot on interest rate cuts? There's a lot of things that could be going on. but the trend is up. So you might have a dip buying opportunity here. Okay. And, you can even, if you want to take a swing on the long side, even have a stop loss like around these lows, because, hey, I want to trade with the trend. If I'm going to be betting on bonds, long-term bonds rallying, long-term interest rates falling, I have a clearly observable risk reward setup here. Basically, my risk is, hey, if we take out this low, the trend is starting to turn. I don't want to trade against the trend. I'm out. And the reward is basically, hey, if we can get back to, even this trend line here, because it looks like you were starting to break out from this pattern that's in effect. This is called an ascending triangle. You have different types of triangles out there, so I'll have a couple that I'll cover with you. Ascending triangle, upper horizontal trend line. The lower trend line is upward sloping. You broke out from that, but it was kind of a fake out. And so you sold off hard, but if you can get back above this trend line, I do think you're back in the continuation camp, continuation of the uptrend that's been in effect since this past spring. So, bonds might have some opportunity on the long side. Here on the bearish side, TMV, you broke down, you had this support zone here, like around 35, 36. You can see, I'm trying to focus on the pattern here, but if you follow my laser, there was some congestion like in this 35, 36 area. And a lot of times when you're drawing these patterns on the charts, you'll see some overlap with support and resistance zones. That's completely normal. That's completely healthy. You should be seeing that. But you had this breakdown in TMV from this inverse saucer pattern. You broke below this, came back up, retested former resistance, turned support, then you made a new low. So it's very similar to what we saw on that previous slide, just the other way. If you take out this high here on TMV, then TMV is going to get you some more bang for your buck than TMF. So all things to think about. We're going to get some more, hopefully some more inflation data. Jobs market making the Fed a little bit jittery. Usually the Fed cuts into labor market weakness. I'm not really sure why Powell hedged his rate cut supposedly for December. We'll see what happens. But right now there's a little bit of jitters in the bond markets, but let's see if that can be resolved here rather soon. All right, let's talk about another area of the market that has been getting a lot of attention this year, and that is precious metals. So you have the gold miner index. Gold has been one of the hottest commodities of this year. Gold stocks have done very well. You can see a very clean uptrend. We're looking at the index here, guys, not 3x bull ETFs, not 3x bear ETFs. From this low in April, the index itself more than doubled. So you can imagine the opportunities that were present on the long side of the mining index over the last several months. So this is absolutely something to keep an eye on right now, because you've had a correction over the last few weeks. But what's more important here is that you've not taken out any significant lows. Like this low from September is holding so far. Even if you were to take that out, there's a pretty important low here in August, more important lows in July. I don't think you're going to come back all the way, but you're setting up for another potential higher low with respect to the longer term trend. You have what's called here a falling wedge pattern, which suggests that a reversal could be in the works. And so if you break above this upper trend line of the pattern, that could be a catalyst to consider some bullish or long opportunities in gold miners. And you see the same exact pattern playing out on, I call it Nugget, NUGT. This is the 2X gold miner index. You can see here that as of yesterday, you were starting to test this upper trend line that was downward sloping. Basically, this pattern represents like a compression of volatility in the near term. Obviously, there was an expansion of volatility. And volatility just means, wide price ranges. It doesn't mean it's, automatically bearish to the downside. You can have volatility to the upside too. A lot of people, get lost on that point. So don't forget that. But, over the last few sessions here, the trading range has, compressed a little bit after widening a few weeks ago. So I'd be watching this falling wedge here. And then on dust, however, I am seeing a little bit of different patterns. You had this descending channel that we looked at that example on the bearish small cap ETF, and you broke above there, but you see how it wasn't that powerful of a rally to the upside. So that's not really uncommon. So this is why I wanted to show you, like, when you break out of these channels, it doesn't automatically mean sharp reversal in the other direction. It just means that the market kind of has to readjust its momentum. The algos are like basically recalculating their slopes and whatnot. And so dust here going sideways. But there was a little bit of a swing opportunity recently in this. I don't know that there's going to be a lot more here near term. You might get a little bit more of a bounce, but I think there is going to be some more bang for your buck, so to speak, going forward with Nugget NUGT over the next several weeks here.
Yeah, and Gianni, just to give a little context of some flows we've seen last week, we saw Nugget was in across our 122 ETFs. It was in the top 10 of inflows, and Dust was on the other side. It was top 5 of outflows. So just to your point, when we see that price action and also that flow action, that's traders taking profit on Dust on that that smaller, shorter term rally, and kind of rotating back into Nugget, where you've seen that in the underlying index about 20% drop since the October highs in the miners.
They're buying the dip.
Yep. So a lot of dip buyers there. Yeah.
Cool. All right, let's take a look at some individual stocks. I'm going to start off with Apple, because I think Apple, you can see here we have this longer term chart going to the beginning of the year. There's that saucer pattern, that same saucer pattern that I pointed out with the Russell 2000. And, Apple was actually lagging for quite a bit of this year. We just now hit a new all-time high a few weeks ago, but before that, Apple had not hit a new all-time high for this entire year. Now, Apple is hardly a winner in the AI arms race. They've kind of thrown in the towel on that, but they're doing some exciting things on robotics and some other cool stuff like that. But what gets my attention here as a trader is this massive base, this massive saucer. I think Apple is poised to be one of the leaders in the Mag 7 going into year end, going into 2026. And one of the things that I've been seeing over the last several weeks within the Mag 7 is just a rotation of money amongst themselves. Some of the leaders that we saw earlier this year, I'll show you some of the charts for like Meta and Microsoft. They've kind of stopped going up, but you've seen a rotation into other Mag 7 names like Apple, like Amazon, like Tesla. And I think that rotation is actually very healthy and is what helps keep bull markets alive. So I have a pretty lofty upside target here for Apple. I think it's a stock that is worth more than $300 a share. In fact, I'm kind of looking at Apple going as high as $330 in time. But I'm saying that to you with the caveat that you don't just buy AAPU and hold it and hoping for a rally to $330. You're looking to capitalize on these swings more or less. So, you had the breakout here on the shorter term from, this ascending triangle a few months ago. That led to a rally, but now you have an even bigger breakout going on. So you're looking at 2X here, AAPU. If you own Apple stock and you're worried about some pullbacks, you have AAPD as a way to hedge. If you don't want to sell, that kind of protects you from having a taxable event. If you've been long for quite some time, instead of having to sell and realize your gains on Apple, you can always hedge for some of the downside action with AAPD. So I like Apple quite a bit. You have Microsoft here. This is what I was talking about a moment ago. Microsoft was on an absolute tear coming out of that low from April, but we've not hit a new all-time high in Microsoft since late July. And most recently, you formed a lower high. This should have your alarm bells going off, okay? Because the integrity of the uptrend is no longer clean. This is going to get messy. This is going to get choppy. Now, you have this support zone with these green bars here, like in the 490, 500 zone. I'm not ready to call it quits on Microsoft as long as we're above there. And it does look like we're starting to consolidate into what's called a rectangle formation. This is another continuation pattern similar to the triangles. And it just means that Microsoft is probably going to be range bound now between like 490, 500 as support and below like 445, 455 as resistance. So We could be looking at Microsoft being sideways for a few months now. But again, the rotation, you had this incredible run up in Microsoft. What was it up like 50 to 60% at least from April to July? You're talking about, a face ripping 3+ month rally in this name. Yeah, I think it deserves a little bit of rest, given what it did over the last several months. So I actually don't really see much of a trade here. I mean, I guess near term, what you could do is consider, buying on support at MSFU. And then if you get, up near resistance, you could even buy some MSFD, which is the bear 1X in Microsoft. Shifting gears a little bit out of the Mag 7, I am watching some stocks in the energy sector. Energy has been a lagging sector year to date, and that's pretty normal in bull markets. You don't really want to see the energy sector outperforming if everything is healthy and well. But here you have ExxonMobil, you have the 2X bull XOMX to the upside, the 1X bear XOMZ to the downside. You have this resistance zone that we've been dealing with now going back into the end of 2024. But back then it was actually support. So this is another good illustration of that principle I showed earlier. You broke support, came back up, you were above it a little bit in March, slammed back lower, and you've seen it rejected, 1, 2, 3, 4, 5, 6, 7 times. Now, as a rule, the more often a market tests support and resistance, the more likely it is to break. So I'm watching this very closely. You get ExxonMobil above 118. I think XOMZ could provide some really interesting opportunities on the long side because you've been building what's known as a cup and handle formation. You have this resistance here around like 118. Here's the cup, here's the handle. And again, this is another pattern that's been forming over the course of several months. This is a big base. So I'd be focusing more on the long side only if you get above 118. Otherwise, I think it's just kind of a choppy market. And there's not really much to do with ExxonMobil. But I did want to throw in a little bit something different because we're right back into the Mag 7 now in looking at NVIDIA. This has been another really strong stock. It's more than doubled since the April low. And I want to give you context because a lot of times people think, I need to trade penny stocks, for big gains. That's not true, especially when you have the opportunity to take on leverage with ETFs like NVDU, Bull, 2X, NVIDIA. So, this stock's up 100% plus on its own from the lows of April. You just broke out from this ascending triangle, very clean breakout. Again, you saw how the trading range got narrower and narrower. You broke above here. This was resistance. It held as support, and then you exploded to a new all-time high. So now you're pulling back from that all-time high. Is this another dip buying opportunity? Well, the trend is your friend, guys. The trend is up, okay? So I do think that there are still some dips to be bought here in NVIDIA. This is the flagship AI play. If you don't believe in AI anymore and you don't want to go out and buy puts and you don't want to short sell the stock and you just want to make a 1X bet on the AI bubble blowing up, well, NVDD is a way to take that type of bet. Although just be very aware that you're swimming against the tide, you're trading against the trend. If you are looking for the trend to change, what's the most recent high or low? Well, it's back here in late October. If you start to take that out to the downside, yeah, maybe the AI bubble is popping. But I don't want to be the first one to make that bet in a trend that's been as strong as NVIDIA has. All right, let's see. Oh, go ahead.
I was just gonna say, all of the Mag 7 and Mega Cap Tech have reported earnings. NVIDIA, you have that big earnings date. I think it's November 19th. Still has not reported. So that's we see a significant uptick in volume around earnings, especially on the earnings date, with the potential of pretty significant swings.
Absolutely. And so, yeah, I mean, it's interesting. You're seeing volume pick up. Earnings is coming up too, but you're also coming up into like this technical support zone too. So, again, this is why technical analysis is so important for trading these types of vehicles, because you need to be able to visualize where the price action, where the volume action is all taking place. All right, let's talk about another big winner in the Mag 7 Google. This is another double since the April lows. You had nice earnings there, new all-time highs. This is actually one I'm looking for it to rest a little bit. The trend has been very strong. So, do you have an opportunity to buy some dips? Yeah, but you need to dip. There hasn't been a dip lately. And if you're looking for some hedging, GGLS, could provide some hedging opportunities. But the trend is very clearly to the upside here. Probably getting more bang for your buck on GGLL with Bull 2X. So that's what I like on Alphabet. I'm always going to call it Google. It's just, a generational thing. I'm sure you're the same way, Eliott. But
yeah, oh yeah.
Okay, now we have Tesla. So this is actually the last Mag 7 stock. You have that big event today, actually, when the market closes. There's that whole voting on Elon's $1 trillion compensation package that's going on. But you have like an event today, like a tech event with Tesla today. But this is the only Mag 7 stock that has not hit a new all-time high yet this year. Now, if you adjust for dividends, you might have a little bit of a different chart, but this is how I look at it here. I've not seen a new all-time high in Tesla yet this year. It's the only Mag 7 name. But what do you see here? You have a massive year-long cup and handle formation. Now, Tesla has some pretty favorable seasonality right now. I want to talk about that real quick, because basically what seasonality is that there's certain patterns in market behavior in certain months of the year, whether it's the S&P, whether it's individual stocks. But if you ever heard, sell in May and go away, or Santa Claus rally, or as goes January, as goes the year, those are all seasonal factors, seasonal patterns that markets tend to exhibit. And so Tesla tends to do pretty well in November and December. We're pressing up against resistance here. Now, while we have not made a new intraday high this year, I will remind everyone that on Monday, actually, we closed at the second highest level of the year at a closing basis, and at the highest price of the year. We actually hit our highest price of the year on Monday. So Tesla's actually selling pretty hard today, but you do have this event coming up at the close. I don't know what's going to happen. I don't know how the vote's going to go. I don't know if it's going to be interpreted good or bad, but when I look at this chart setup, I'm interested in the long side of Tesla. I think you're going to have a big breakout. I think this is going to be the stock of the Mag 7, together with Apple and Amazon going into the first couple of quarters of 2026. And all we're looking for is for this stock to get above like 470, 475, and then we're off to the races. So I'm bullish Tesla. I like the setup here, but it's not one to necessarily force the issue until you get the breakout. So my strategy on this would actually be looking to buy TSLL if you get the breakout from the cup and handle pattern. All right, Palantir. Palantir really gets people going because it's like their valuation is absolutely ridiculous. It's like the highest valued stock in the S&P, I think. Like, you look at it compared to historical stocks and valuations, it's completely out of control. Well, the performance has been remarkable as well. And you look at the setup here, it's obviously been in an uptrend, higher highs and higher lows. You have this ascending triangle. You broke out from that. You already got past earnings. Do you have another dip buying opportunity? Just because people are angry about the valuations doesn't mean that's the end of the road. Okay. Again, remember, the market can stay irrational longer than you can stay solvent. So in looking at Palantir here, you had the breakout from the ascending triangle. That's pointing to a continuation. You're retesting former resistance turn support. Is there a dip buying opportunity here with PLTU? If you're trading with the trend, there's a good argument to be made that there may be. You look at your risk. If you want to stay with the trend, well, keep an eye on these lows from mid to late October, because you take these out to the downside, well, then the bulls are going to have some problems. Then PLTD, if you want to go out and short arguably the most expensive stock in this market, you have a way to do it with PLTD without, buying options, without short selling outright. Might be some opportunities there. Last and certainly not least, you have Meta, which, was a big leader coming out of that low in April, but a really nasty breakdown here. And I want to illustrate the importance of trends, because I don't want you to think I was just blowing hot air during this entire hour. No, like there's actually some some observable shifts in the trend that warned of this recent drop that we had. I believe it was after earnings, if I'm not mistaken. But okay, so you had a clean up trend from that April low, right? Higher highs and higher lows. Then you hit that high in August. You came back down. Okay, another higher low. But then the real warning sign was in September. You formed a lower high compared to that high in August. Okay, so your alarm bell should be going off. Then you sold off into this low in October that was below the low in September. Big, big problem. And then you rebounded again and formed another lower high in late October. So you had 2 consecutive lower highs, a significant lower low, and then you had this huge gap down. This is looking real nasty. I don't like what I'm seeing here. You call this a rounding top. You could be looking at, Meta dropping maybe to like 575 before all is said and done. But this is why I was talking about the rotation within the Mag 7. I'm okay with Meta breaking down as long as Apple and Amazon and Tesla are breaking out. If those stocks don't start breaking out and Meta is breaking down, it's a big warning sign for the overall market. So what do you need to see if you're a bull on this? Well, you need to see it get back above 700. You have this, what was support, okay, in like the $680, $700 area. It broke. It's now resistance. So Meta, I think you're going to get more bang for your buck on METD. Selling the rips versus buying the dips on Meta. It's got some serious issues right now. This is the one to avoid on the long side until you basically get back above 700 when it comes to this stock. So I know I threw a lot at you, but just to kind of rehash some of the things that Eliott said, leverage can be very rewarding and very cruel. These are not buy and hold vehicles. You cannot afford to stay wrong for long when trading on leverage. Know your risk, your time horizon, and your plan. These are for swing trading and day trading. And then position sizing, something you need to think about as well. One trade should never make or break you. These are not your golden ticket ETFs to, untold amounts of wealth. Your system is your edge in this trading business. One trade never makes or breaks me. And, the way I trade, think about risk reward ratio. I only need a break even rate of about 25% in order to not lose money, meaning that I only need to be right 1 out of 4 times on my trades, given my risk reward ratios to not lose money. So I'm winning, in theory, less than half the time, but still not losing money. That's really important concept when it comes to trading. So we don't have time to get into that today. That's a conversation for another time. But if you want to stay connected, you can follow my X or Twitter account, Gianni_DiPoce. I don't know if we have much time left for questions, but that's what I had left. That's what I had for today. Eliott, if you have any final words or final questions, we can tackle those now.
Yeah, no, definitely. I know everything that you said. Definitely trend is your friend, and just with these products, please definitely take a look at educational material. We have a great education section on our website at Direxion.com. Understanding leverage and inverse ETFs discusses exactly what we've talked about today, just with the leverage exposure, with volatility, and how that can impact the return of these products for when holding longer than a single trading day. And these products really are intended for short-term tactical trading. And Gianni, I think you did a great job of summing all that up, but just wanted to reinforce it.
Great. No, it's so very important. So, all right, Eliott. Well, pleasure as always. Big thanks to Direxion and for coming in and sharing some very important information on how to use these vehicles properly. And I hope you enjoyed some of the due diligence that we shared here today, where some of the opportunities may lie going into year end and into the beginning of 2026. So that's going to do it for today, Eliott. Thank you.
Thank you, Gianni. Looking forward to next time.
All right. Take care. All right, everyone. Thanks again for joining us today as we capped off a very impressive session with Direxion on volatility, momentum, and the Endgame. We looked at leveraged ETF strategies for Q4 and beyond. Thank you so much for joining us here at Benzinga. I'm Gianni DiPoce, and that's all for now, everyone. See you next time. Take care now. All right. We're off, right? We're not live anymore.